I've always felt that getting a brand new loan from the bank is a lot easier than to go down the path of getting refinance done. So because it's new business, banks are hungry. They would be a second or third tier lender would be like, yeah, I'll give you 80% LVR on a brand new loan. No problems. This is a house that you're buying. When you go to the bank and say, hey bank, this is the house. It's grown up in value. They'll trigger a valuation. They'll ask for so much paperwork in order to release that money. They might not even release your money. Sometimes it's in a tranche, right? And they'd be like, we've set up this tranche for you and you can basically dip in once you find the property, right? So a lot of the brokers, in order to basically bypass some of this work, of course, what they do is, they cross it. And from a bank's perspective, it's easier. It's a lot more convenient. Hello and welcome to another episode of Help Me Buy Property podcast. And today's topic is a topic which is very near and dear to my heart. This is a topic that we have talked about for years and years, but I have an expert in the house who is going to talk all about trust lending from an eyes of a mortgage broker. And so not from an eyes of a buyer's agent or a property developer, but eyes of a mortgage broker. We're also going to talk about standalone versus cross-collateralized loans and which one are better and why they are better. So without further ado, let me introduce my co-host today, Chris from Unconditional Finance. Chris, how are you today?
I am good this afternoon, Moss. Thank you again for having me, and hello, listeners.
Welcome back, Chris. It's always amazing to have such wonderful, deep, conversations with you. And so today we are talking about trust lending. So for viewers and listeners, explain to us, how does trust lending typically works?
Flavor on a lot of people's, word on a lot of people's tongues at the moment, trust lending. And yeah, you didn't really hear, we've always been strategizing and, understand the pros and the cons from a lending point of view in terms of, a trust. But yeah, I'm monitor and, participate in a lot of forums and investment forums, and sort of, every sort of third or fourth question now is around trusts and what's the benefits and stuff like that. So but I won't say it's been a secret, but again, sort of investor-friendly brokers have been playing heavily in this space for many, many years. And yeah, I guess there's pros and cons to everything, and there's pros and cons to obviously buying a property inside of a trust.
Let's start with the con. Let's talk about why there is this bad stigma attached to it. Why does a broker would say that, okay, trust lending is bad and you should never do trust lending?
Yep. Yeah. So one is they don't understand trust. They might get respectfully, a big bad trust deed, which could be sort of 60 pages long, and that actually understand what that particularly is. So that's one part to it. So you definitely want to be working with somebody that understands trust, different types of trust, discretionary units, yada, yada, yada. So it's the negative in terms of trust is cost to start with. Obviously, you have to get an accountant, Mr. Client or Mrs. Client, to establish that trust deed. And, accountants can vary between $1,500 to maybe up to $4,000. So if you're setting up multiple trusts, it does become an expensive exercise. And the good old accountant normally charges you more at tax time as well to obviously do your personal returns and your trust returns. So that's one part. And, there is a little bit of paperwork. It's another negative, Moss, from a lending perspective is, banks are, well, not all banks, but some banks are really restrictive around trusts. So we've got 60 plus lenders on our panel. We might have only 25 lenders that play and lend clients under a trust. So that's another thing. LVR restrictions. Some banks actually have, loan to value ratio restrictions on lending in a trust. They won't go over 80%, or they won't do interest only and things like that. So it is a bit more of a narrower lending environment when you buy a trust.
Definitely.
Yeah, that's probably the negatives to it.
One thing that I always feel also is that, this is, when you talk more from a cost perspective, I think you've covered pretty much everything. There is always independent legal advice attached to the majority of the trust lending. And so that is a cost that comes in later part of when the docs are coming in. It's like, oh, where did this come from? All of a sudden you're paying like $500 to sometimes even $1,500 to a lawyer for 20 minutes of a conversation, right?
Yeah. And the documents are a lot more cumbersome. So clients that have properties in their personal name, and they do that first one in a trust, and it comes out. The banks they're slowly moving to electronic docs with trust.
And the lawyers, they scare the shit out of you, right?
Yeah.
They'd be like, oh, you're signing your life away, and this is a trust document, and there's personal guarantees attached to it. But I think people are getting a lot more used to it. And so, of course, there is a lot more paperwork. There is no doubt about it from a broker's perspective. And so I understand that they are not remunerated anything extra for doing all of this paperwork, right? So the only sort of goodwill is that what they're creating is that they're working with the client on a long-term basis, right? So basically,
Correct.
that's what goes through.
Yeah, some brokers prefer PAYG, one payslip each, not self-employed, or you could be PAYG,
100%.
but you've got multiple properties in trust. Again, if you don't understand what that transaction is, how to read a trust deed, how to read financials, et cetera, then, you are going to deem it scary. But, I guess it's a space that we play heavily in and day out. So
definitely. So why use trust? Like, if there is so much bad about trust, there's cost, there's LMI, there's LVRs. Why would, astute investors like you and me have multiple trusts set up? And we basically advocate trust and, say, look, trust is the way to go.
Yeah. Yeah. And why you would do it without we don't have sort of an hour and a half to go through it all. But yeah, and you again, Mr. and Mrs. Today, you've got to get your advice from your accountant as well. We can't give advice around that. But yeah, from a lending point of view, there's two things. One is asset protection. So, you might be self-employed, or you might have your own home in your personal name. So that's one thing. Some clients set up a trust for asset protection. The big advantage in terms of lending, and a lot of property investors in terms of buying under a trust is the way the banks look at trust, boss, is they treat it like a company.
Yes.
So you might have 2 or 3 different trusts. They're looking at that as if they're 2 or 3 different companies. And what is the income and what is the liabilities associated with that particular company only? That's probably the simplest way of actually explaining that.
Yes, agree. And I think the best way, and just to add to that, I think the best way to think about this is that when you think about trust, the bank is not assessing the trust through their own internal framework. They are depending on externals to basically do those assessments, right? And so this thing that we were talking about where your rates are at 6%, they're assessing you at 9%, they're shaving off, 80%, all of that disappears by one magical thing, right? And, of course, we're not going to talk a lot more detail into some of these things, but I would strongly counsel people to reach out to Chris or an astute investment broker or come out and talk to us as to how does that magic works in relation to trust.
Yeah.
One more.
Yeah, sorry, mate. I was just going to say, a very simple one, like self-managed super fund lending, you buy a property in that, the banks do not look at that loan inside of a self-managed super fund trust. So 100%. Your own personal trust or discretionary trust, there's certain benefits there as well. So again, we won't go into it in full detail, but it really is not magical, but it really is a way that you can continue your property journey or your lending journey where other banks or other brokers may have said, hey, you've obviously reached the end of the line in terms of your borrowing capacity. So yeah, it's all astute professional investors have a certain portfolio with a mixture of loans inside of a trust.
And of course, ultimately, the land tax side of things and managing the land tax, right? I think that's one of the most important benefits. So while asset protection and, building up a scalable and a sustainable property portfolio is important, I think land tax is one of the biggest reasons, when you're buying properties under your own name, you can reach those thresholds very quickly, right? And then next thing if you are, especially in Victoria, they'll slap you with massive land tax bills, when you basically breach those thresholds, right?
Especially Victoria. No offense.
Especially Victoria,
Moss,
yes.
I know you're down there. So. Correct. Yeah, there's huge lending advantages by, again, Mr. Client, get your obviously advice, but there's huge lending advantages or benefits in the future by potentially buying in a trust. And again, we can discuss that with you clients offline.
Do you see this appetite changing from a bank's perspective, where they've seen all of a sudden, this trust lending taking off? And, I call this the rich strategy, right? Because these, we've been doing trust. Like, I remember I set up my first trust in 2014 when no one knew. I knew had trust. And I found that out, not 2014, actually 2012. I found out the trust from this person who was filthy rich, and they've been having offices and, trusts for God knows how long, right? So this is not new news. It's just that it's becoming more mainstream a lot more now. Do you think that the bank's appetite in lending in trust would change quite significantly over a number of years?
Yeah, short answer, no. Like, it's not under the NCCP. Like, it's not a consumer loan by lending under a trust. And caveat is, we've actually got a client now, they've actually had the trust set up incorrectly. So they want to sort of implement this strategy, and they haven't actually had it set up correctly as well. So there's certain ways in terms of the trustees and things inside of the trust that it has to actually be set up to actually get that benefit as well. I guess it's becoming more prominent now, Moss, is because obviously lending's getting a lot harder. Property investing is a game of finance at the end of the day, respectfully. So without the finance, you can't obviously continue your property investing journey as well. So I think over the years when rates were sort of 2.5%, you could still buy 3, 4, 5, 6 properties using just lenders' personal names only. But now obviously rates they're sitting at 6 to 7% for investors. This strategy is becoming a lot more prominent with all our clients.
Definitely. And of course, ultimately it comes down to keeping your overall trust sustainable. Now, one of the biggest mistakes that I see people make all the time when using trust is they hear about trust from someone, they fall into the FOMO without realizing the benefits and the pros and cons analysis. And they reach out to Mr. Broker and say, hey, broker, I've got 6 properties under my personal name. I have 0 servicing. Do the magic and get me the borrowing in the trust. Is that possible, Chris?
No, yeah. So this, again, we won't go fully down the rabbit hole today, but yeah, structure, super critical in terms of don't make the wrong mistakes with your first few properties. I've got a guy now, I won't actually name him, 12 properties. He wanted to save a little bit on tax. So he's got 6 properties inside of a trust with no debt against it. And he's got 6 properties in his personal name with about $2 million of debt. Anything in your personal name needs to be included. We can't be that creative. We can't exclude that debt under their personal name. So he's trying to save himself $20,000 in tax per year. Oh, I'm smart here. I'm going to get 20 grand off my tax bill. But because all these loans are under his personal names and not his trust, I can't do anything around
100%.
that lending. So again, it's super critical. Don't come to us on the third property when your borrowing capacity is already maxed out going, I've heard Moss talk about this wonderful trust structure. Can you help me, Chris? It's too far. And it's too bloody expensive, Moss, to change. Like,
100%.
Obviously move the property from your personal name to your trust, as you would know, Mr. Clients. You're paying full stamp duty again. So that's an expensive exercise.
100%. Even if you set it up wrong, right? Just fixing those setups. Sometimes it's painless, but sometimes it's very painful as well. Yeah, look, ultimately, I use this example with one of my clients where I said to them that trust is like a child. When the children are born, they're dependent on their parents to feed them, grow them. And once they grow, they are on their own. And so trust is exactly like that. So the trust is dependent on your servicing when they are set up. And once they are grown, that's it. They have their own servicing, they have their own life, they can basically follow through, right? A lot of people don't understand that. They think that the trust has some sort of magical powers, like a kid who is 6 months old and he would start eating with their own fingers and hands and start walking. It's not possible, right? So people need to understand that major difference between the two.
Yeah, I love that analogy. I am going to look at my 2 young ones as trusts when I walk in the door this afternoon. But it is, and it's not a magic bullet or not a magic pill for today.
Yes.
This is a potential future lending benefit for you, Mr. Client, in the 100%. Future. Like you said, they crawl, they walk, and then they obviously grow. And that's a great analogy, actually. Awesome.
100%. Yes. Thank you. And look, ultimately, when you're talking about trust structures, you go out and speak to your accountant. You need to keep the tax man happy. That's always a given, right? But in order to save $20,000, you are missing out on like $500,000 to $1 million worth of servicing. That's ridiculous, because imagine even if that $500,000 property grew by a lousy 2 or 3%, you would wipe away your tax benefits by at least 2 or 3 times. And so you need to look at a much more holistic view of the world as to, okay, what are you trying to do from a net wealth creation? And,
correct. Yeah, that example I gave before. Yeah, sorry to interrupt, mate. Yeah, that example, that's $1.5 million, potentially less borrowing power because you wanted to save $20,000 in tax. What can that do to your overall wealth, your overall property portfolio? So like you said, you got to look at it from a holistic point of view. If you're unsure, if you're starting your journey, get the correct advice up front because it could cost 100%. You in the future.
Let's segue into another topic, which is again, very linked to this, and it is more in relation to standalone versus cross loans.
Yep.
And I've heard bankers and brokers play on both sides of the camp, but I know for a fact that banks love cross-collateralizing your loans.
Yeah.
And the brokers are always at the other side of the camp saying, hey, you shouldn't do this. But the owners do not understand. I think we have a typical client, and let's not name him, where he's like, hey, my interest rate is so low, I would rather just cross my loans and, get another property and pay $0 versus refinance that and, get a new loan. So let's, from a user's and listener's perspective, let's help them understand what is the difference between standalone versus cross.
Yeah, I mean, to me, I wouldn't know how many loans we've settled, maybe 1,800 in the last 8 years. And I think I've probably written 1 or 2 loans crossed together. To me, it's lazy lending. And what I mean by that, because there's a little bit more work involved. I mean, you're pulling, there's more loans involved. There's obviously a little bit more work from a broker's or a banker's perspective. I think all bank staff get just trained and it's grilled into them. You must cross everything. And to me, that's a control thing. Like they want to obviously control you. So if you've got 3 or 4 loans and properties with that one bank, you're less likely to actually move banks. But there's huge, disadvantages and negatives by actually crossing your loans. And I mean, do you want to quickly touch on a few of them?
Please. Yes. Yeah. I think for the viewers and listeners, I think it's a very important topic. I've fallen prey to this in my prior life as well, where I was dealing directly with the bank. And that was the day where I divorced NAB. So if there are NAB listeners out there who work in NAB, they should know this, that, it was because of this. They crossed my portfolio between 3 loans and I only found out when I was selling it. And so a lot of people don't even realize, right? They get the docs, no one reads the docs, and that's an unfortunate truth, right? You just sign the bottom line depending on, who is presenting the docs to you, and you let it go because you are so excited with the settlement around the corner, right? And then all of a sudden you find out 2 years, 3 years, 4 years down the track that, your loan is crossed. And, in order for you to release this, you have to either pay more money to the bank so that they can reduce your LVR. And that's a spanner in the mix. And so let's unpack this a bit more so that people can understand this.
Yeah, it's good explanation as well. So we do get clients 2 or 3 years later, they're doing a bit more research into property investing and, why my loan should be standalone. And hey, Chris, I've gone back to the bank, the big bad major, everything's actually crossed together. I'm actually stuck. I can't do anything. I guess one advantage why you wouldn't, we'll touch on that to start. One advantage why standalone is better. Let's say you've got 2 properties. One property goes up $100,000. One property goes down $100,000. So your net position is still the same if both properties are actually tied together. But by having them as standalone, the bank is not actually looking at that standalone security where the value may have gone down. They're just focusing on that one property where the value has gone up. So you can obviously take out equity from that property immediately. Having it crossed together, they're looking at your net position across all loans and all security properties as well. And I think we touched base on a previous episode, mate, where we can sort of manufacture growth by using a valuation strategy, and having all your loans crossed together, you limit yourself in terms of obviously the ability to actually access equity. So that's one part. Another part is if you're selling a property as well, and I've seen this before where you might have 2 or 3 properties all crossed together by the banks. Clients aren't actually aware that the bank, when selling property A, they're actually valuing property B and C as well. And property B and C haven't come up to the value that the clients actually thought. So instead of getting $500,000 net sale proceeds from property A, they're only getting $250,000, which throws their whole plans into chaos because they need that $500,000 to obviously buy their future home. So that's another key component just to sort of focus on as well. By having them as standalone securities, if you were selling the property clients, then the bank focuses on property A only. They don't look at property B or C, and they don't need to be valued. So.
And from bank's perspective, look, it makes sense, right? They'll hold the whole portfolio ransom. So you go down at one place, I have 4 other properties that I can basically dip into in order to make up my losses, right?
Yeah.
Whereas from an investor's perspective, you want to hedge your bets against each other, right? And so be like, well, if I go down, God forbid, touch wood, if I go down with one property, you just take away this one property and that's it. You don't touch my other property portfolio, right? And that's where trust and standalone properties play a really big part together because, that's the generational wealth that you're talking about.
Exactly, mate. Yeah. And having them standalone, there's no recourse on the other properties. Like you said, they're focusing on that one only. So, and the other point, just quickly before we move on to the next subject, I mean, LMI, it's a huge thing. LMI, Lender's Mortgage Insurance, for those that don't know what LMI is, it's a tool, less than a 20% deposit. The banks obviously have a lender's mortgage insurance cost built into the loan or capitalized on the loan. And, as an investor, LMI is a tool that's going to help you create wealth. But if your loans are crossed together, the LMI on that's going to be astronomical because you've got 3 loans that we're trying to take just one of them, or we're just trying to take it above 80%, but the bank's actually assessing the full debt across all 3 tied in securities. So the LMI charge is going to be astronomical. Again, if you have all your loans structured correctly, they're standalone. We want to take the loan above 80% for property A. You're only paying LMI on property A only. So that's another huge point I wanted to highlight, mate.
Definitely. Yeah. And I think, again, expanding on a bit more on that, I've always felt that getting a brand new loan from the bank is a lot easier than to go down the path of getting refinance done, right? So because it's new business, banks are hungry. They would be a second or third tier lender would be like, yeah, I'll give you 80% LVR on a brand new loan. No problems. This is a house that you're buying, right?
Yep.
But you go to the bank and say, hey, bank, this is the house. It's grown up in value. They'll trigger a valuation. They'll ask for so much paperwork in order to release that money. They might not even release your money. Sometimes it's in a tranche, right? And they'd be like, you've set up this tranche for you and you can basically dip in once you find the property, right? So
Yep.
a lot of the brokers, in order to basically bypass some of this work, of course, what they do is, they cross it. And from a bank's perspective, it's easier. It's a lot more convenient. But understand that the refinance money, the cash refinance money that you get out of the equity is a lot more important than using that money to buy a property of cash. And so I'll use an example of a client of mine. He had close to about $500,000 in equity.
Yep.
And his broker basically took that money and bought a property. And I was like, well, you literally bought the property of cash. And he's like, no, but it's still bank debt. And I was like, no, this is like you've used the whole cash to basically buy the property.
Yep.
It's such, you see these examples time and time again for people doing that.
Yep. Yeah. Again, there might be the odd occasion, but I think I can count on one hand out of 1,800 loans settled in the last sort of 8 or 9 years why you would actually set up the loan crossed. Yeah, one of the points we're seeing, my broker wanted to cross so I could get a lower interest rate. Again, investor property mindset, it's a game of credit, it's a game of equity, it's a game of finance. It's not, hey, I'm saving myself 0.1 or 0.2% on this. So again, we spoke about it before, Moss.
100%.
Getting your loan structured correctly up front, that is super important with pulling out equity, making sure your loans are always standalone.
Last but not the least, and I think this is the most important question, standalone loans with trust structures play a massive part in property development. So if you are buying a property for an opportunity to develop in the future, how important it is for you to pick up the right structure and keep it standalone.
Yeah, 100%. Like, I don't know why, again, you will cross lazy lending. You can use that word. So,
lazy lending, yes.
I guess
100%.
Consumers out there listening today.
Think forward, right? I think that's what it is. People don't think that much. Like, people naturally don't think about exit strategies with their property, right?
Yep.
So they would buy a property and 10, 15 years down the track, they'd be like, someone told me that I can develop this property into 4 townhouses and I'm trying to do that. And then next thing you know, that property is sitting in their personal name. It's crossed against 3 different loans, and be like, well, you need to take it off. You need to take the chains off for you to actually develop this property, because then the new lender would take the whole thing, with them, and you're basically exposing yourself to a much more bigger risk by giving away so much equity.
Yeah, correct. Well explained. Yeah. And I mean, the other point is we've seen clients, their loans are fixed, but this property has all the equity. Because all your loans are actually fixed together, I can't actually break out of what I'm actually doing. It's going to cost me too much money, Chris. I can't then access the equity in property C as an example.
Yes.
So yeah, super critical. Standalone is what we advocate for majority of times, whether you're doing developments or, just growing your normal portfolio. There's, to me, no real reasons why. And, question that with your banker, question it with your broker and let them see what they come back with, why you would actually set up the loan and cross everything in together.
I think golden words. I think let's wrap it up there. Question your broker, question your bank. Ask them the question as to what is the reason they're not asking you to set it up in a trust. Ask them that why are they crossing your loans and what is the real reason on them not suggesting you a much more contemporary, non-conventional strategy. So always ask the right questions. And if you have any questions or comments for Chris or for myself, please jump into the comments or reach out to us. Thank you for listening to us today. Take care, stay safe. Keep smiling, keep investing, be kind. This is Moxin, Chris checking out. Adios.
Thanks, boss.